Welcome to This Explainer. Look, today we are untangling a massive, massive wave of global market chaos that basically left investors all around the world scrambling. We're going to trace a financial shockwave that literally started right in Silicon Valley, crashed hard into the Asian markets, and then left investors over in India holding their breath for an entire long weekend.
Now, you might be wondering, did a single delayed tech listing really just wipe billions of dollars in value off the global equity markets? I know, it sounds almost impossible, right? But that is exactly the central mystery we're unraveling today. We're going to look at how a market, one that's been running entirely on the sheer hype of artificial intelligence, reacted when its single most anticipated debut was just suddenly put on ice. So here is our flight plan for today. 1. The OpenAI IPO catalyst. 2. Asia markets see red. 3. Wall Street's mixed signals. 4. Will DeLaw Street crash? And 5. AI bubble or valuation reset? Let's get into it. Section 1. The OpenAI IPO catalyst. Okay, so it all started with this single report from the New York Times indicating that OpenAI is considering pushing its highly anticipated IPO from 2026 all the way back to 2027. Now, in a market environment that has been running on basically pure AI euphoria, this delay acted like a bucket of ice water. Investors have been banking heavily on the rapid commercialization and public offering of these AI pioneers. So putting the sector's absolute biggest float on hold, yeah, that deeply rattled investor confidence.
And honestly, this just brilliantly illustrates how incredibly interconnected our modern tech ecosystem truly is. A scheduling delay reported out of Silicon Valley doesn't just affect American investors, it spreads continuously outward, kind of like a pebble dropped in a very, very large pond, sending these immediate shockwaves all the way across the Pacific Ocean.
Section 2. Asian markets see red. And the sheer scale of this drop, it was massive. On Friday, South Korea's Kospi took a really heavy hit, plunging 5.81%, which even briefly triggered a circuit breaker. Japan's Nikkei 225 wasn't far behind at all, falling 4.15%, while China's CSI 300 dropped 3%. Literally billions of dollars in market value were wiped out in a single session as panicked investors just rushed for the exit, terrified that AI valuations had finally become way too stretched. But you know what's really interesting here? It's exactly who took the hardest hit. SoftBank Group plummeted over 12%. Why? Well, because the Japanese conglomerate built a massive portion of its entire investment thesis directly around its stake in OpenAI. Pushing back that IPO directly pushes back SoftBank's potential returns. And then other major tech shares like memory chip maker Kioxia and semiconductor manufacturer Advantest, they basically followed suit with brutal double-digit drops.
Actually, wait, we do need to provide some context here. These markets didn't just drop out of nowhere. Before this brutal Friday sell-off, Japan's Nikkei had actually surged 35% over the previous quarter, and South Korea's Kospi had put in an extraordinary 66% quarterly gain. When markets move up that fast and that high, they naturally become prime targets for quarter-end profit-taking. So the OpenAI news, that was really just the match that lit the powder keg of an already stretched market.
Section 3. Wall Street's mixed signals. Now, if we look back across the Pacific, unlike the sharp sell-off in Asia, Wall Street gave us a very nuanced, kind of mixed picture. And this brilliantly illustrates the two sides of the AI coin right now. On one hand, you've got Apple sliding 6.1% after announcing steep price hikes on its devices, which was driven by the surging costs of memory chips. But on the flip side, memory chip supplier Micron Technology actually surged 16% to a record high because of that exact same robust demand. So hardware makers are feeling intense margin pressure, while the chip suppliers are still just raking it in. Adding to this already complex picture on Wall Street is this specific number, 4.1%. That was the US PCE inflation rate, marking the highest level we've seen since April 2023. This added a really thick layer of underlying economic tension to the tech stock volatility, right? It caused traders to start nudging up the probability of interest rate hikes before the end of the year, which just further strained overall market optimism. Section 4. Will DeLaw Street crash? Man, imagine the tension here. On Friday, Indian markets were closed for the Muharram holiday. So Indian investors were literally forced to sit on their hands, on the sidelines, for a 3-day weekend, unable to execute a single trade, just helplessly watching the global market rout unfold. The big suspense looming over the whole weekend
was whether Monday's reopening would trigger a massive, compounded sell-off reflecting all of that pent-up panic.
But to calm that panic, we gotta look at the expert analysis. CB registered research analyst Shashank Udupa noted that, sure, while a negative opening was likely, early indicators like the GIFT Nifty were actually only down by a fraction of a percent, around 0.25%. He made it a point to emphasize that India wouldn't see anywhere near the 4% to 6% damage that we just witnessed in Korea and Japan.
Let's break down exactly why India actually has this massive shock absorber built in. North Asian markets are heavily concentrated in tech, semiconductors, and exports. So when AI takes a hit, their entire benchmark indices absolutely plummet. India's economy, however, is driven by highly diversified sectors, domestic consumption and financials. Plus, you have these massive inflows from domestic institutional investors that have consistently absorbed foreign selling, acting as a really powerful buffer against all this global tech volatility. And what about Indian IT stocks specifically? Well, they had honestly already taken their medicine. The Nifty IT index had already fallen 6% to a 3-year low right after Accenture cut its guidance. This means Indian IT stocks were already trading much cheaper and basically carried virtually no inflated AI premium left to surrender. They simply just aren't in the same AI bubble that those North Asian tech stocks are currently unwinding.
Section 5, AI Bubble or Valuation Reset. Now, if you are actively watching the markets, here are your actionable takeaways on exactly which sectors to keep a close eye on. Companies linked to the global AI supply chain, they remain highly vulnerable and could definitely see further pressure. Conversely, banks and consumption-focused companies are expected to provide relative stability. Meanwhile, high beta sectors like capital goods and defense, they are going to see very high volatility in those crucial first 90 minutes of trading. So the big picture is summarized perfectly right here. The experts largely agree that what we are seeing is definitely not the beginning of some catastrophic global bear market. Instead, this is a healthy, albeit painful, clearing out of stretched valuations in the world's most expensive AI trades. The underlying fundamentals, especially in diversified markets like India, remain totally intact despite all the heavy profit-taking. Which leaves us with this final thought. We've seen billions wiped out in a matter of days, yet at the same time, chip demand continues to absolutely soar. So is this dramatic shockwave the violent popping of a dangerous AI bubble? Or is it simply a necessary healthy valuation reset before the industry takes its next massive leap forward? Make sure you keep an eye on those upcoming earnings reports, because the answer is going to define the next decade of the tech market. Thanks so much for joining me on this explainer, and as always, keep learning.